From breaking new and updated news on coronavirus to why you should believe and expect a 20% stock market crash in 2021 to Dow Jones futures and Congress fast-tracking Biden's stimulus check plan despite the rallies of a market crash ensuing. It's a lot going on right now on Practical Absolutes. Today's February 6, 2021. Japan's central government has been urged by governors just today to reveal a coronavirus vaccine plan to roll out. Over 21% of the people, according to Tokyo Medical University institutions, are washing their hands appropriately. So you know what that means. We got like 79% of the population not washing their hands appropriately, according to Tokyo Medical University. It's wild. According to NPR, ever since the coronavirus reached the U.S., officials and citizens alike have gauged the severity of the spread by tracking one measure in particular, which is how many new cases are confirmed through testing each day. However, it has been clear all along, allegedly, that this number is an understatement because of the testing shortfalls. I mean, me personally, I feel like testing is not the best thing to be worried about. It should be fatalities. When it comes down to vaccines or whatnot, it should be definitely fatalities, especially if it's a 90%, live rate, you know what I mean? But according to Columbia University, new research has built up a mathematical model which gives us a more complete picture of how the virus is circulating in our communities. According to Columbia University, on January 31st, there was 1.2 million people who were currently infectious. And considering the margin of error, it could be as high as 1.9 trillion. There were less than 150,000 people who tested positive and 323,000 people who tested positive and became infectious. In another study, researchers with the CDC showed a model was similar to the model previously discussed, but it was more rudimentary than the version that the Columbia's team used to found that the actual infections were 8 times higher than reported during the first 7 months of the pandemic. More on that in the future, but here's why you should expect a 20% stock market crash this year. And if history proves accurate, a volatile year may await once again. This will be unprecedented, though. We know that day trading and momentum chasing, it's like an awesome thing to do, you know what I'm saying? Especially for the first few weeks of the year, But when operating earnings growth that drives equity valuation substantially higher over the long run, is exactly why we have to pay attention to the market-based fundamentals, no matter what's going on. For example, Shiller's price to earnings, the P/E ratio for the S&P 500 is very important. It differs from the standard PE ratio that is based on the average inflation-adjusted earnings from the previous 10 years as opposed to just earnings from a single year. Looking back 150 years, you'll see that it's a lot higher over the past 25 years. It averaged over 16 and nearly 17. Admittedly, the advent of the internet was broken down, in the market crash in 03 and whatnot. It made a lot of information barriers for retail investors, But lending rates that are low for more than a decade have fueled borrowing and lit a fire under growth stocks, especially SPAC stocks. And one of the most telling statistics comes at the hands of JP Morgan Asset Management. And they spent over 20 years rolling out returns for the S&P 500 with multiple different end years. And one figure stands out. Allegedly, roughly 50% to 60% of the market's best single session gains occur within a few weeks of its worst single session performances. This is a fancy way of saying that when you run for the exit, you're almost certainly going to miss out on some amazing bargains, and the market's biggest days are still coming, in which case you will miss out on a handful of these big up days that can literally be detrimental or exponential to your wealth. It can be tempting to try and get rich quick. I don't like the word rich. I like being wealthy, me personally. I don't want to get rich quick, but most people do. They use these schemes in the market to attempt to start their finances and whatnot, whether they're investing in risky penny stocks or throwing all their money in an up and in upcoming business or trying to get up on some fiasco like GameStop, trying to get rich overnight. Some kid in Florida just not too long ago, 28 years old, shot himself in the head. He's a GameStop trader. Saw how much money he could have made and didn't make it. He probably was doing option trading. I don't know what he was doing. He ended up killing himself after. It's not worth it. Trying to get rich quick to get speedy gains, to hijack your dopamine reward system is not worth it. I'd always, say that you should go after long-term investments because there's no single investment that's guaranteed to make you rich. But if you're investing in individual stocks, don't worry about trying to scalp or day trading. Like, try investing in index funds if you can't handle the heat. Try real estate, blockchain, e-commerce, genomics. These are things and whatnot that are going to be in the future, that are going to be huge in the future, a lot huger than they are. Check out for them. So it seems that the House finally gave approval Friday just to a budget resolution that paves the way for President Joe Biden's $1.9 trillion stimulus plan. The Dow Jones futures will be open Sunday afternoon, as well as NASDAQ and the S&P 500. So the House voted this just past Friday with a tally marker 219 to 209 with the House winning, and Vice President Kamala Harris casting the tiebreaker vote. The House had already approved the budget resolution just this past Wednesday, but had to okay the Senate's largely symbolic changes. This has been Practical Absolutes. Thank you for watching.